Hey everybody, Smart Silver Stacker here. Hope you're doing well. So as you're probably aware, we are in the midst of a major breakout in the precious metals pretty much across the board. We've got gold futures today over $3,600. The silver price has broken above not only $40, but now silver is above $41. But today I want to lay out a potential scenario for you, which may play out over the course of the following weeks, and it may start as early as this Friday, that's in 2 days, a series of events that could drive the silver price above $50, not just by year end, but by the end of this month. We could see $50 plus in September. We'll also cover some of the other factors that are driving this breakout, so let's get to it. Buy your gold and silver at SD Bullion. Right now, new customers get gold or silver at spot by visiting sdbullion.com/new. Okay, so let's start out with the chart of silver today, and we're going to make this relatively quick because we have a lot of charts to look at. The price action has been very exciting thus far this week in the precious metals. As you can see here, we've got silver above $41. That's pretty significant. $40 was a major level that we've been talking about for some time on this channel, and how once the silver price broke above $40, we were going to begin to see a rapid ascent to record all-time nominal highs. That would be $50 plus, and it looks like we are well on our way. Now, looking at this chart, the RSI, that's a measure of how overbought or oversold an asset has become, is running rather hot right now at 77. Now, that doesn't mean that silver couldn't go higher from here, but I suspect that probably for the rest of the week, we're going to see a little bit of consolidation. Now, that's just kind of speculative. Long term, I remain very bullish. I wouldn't even be surprised if we see maybe a retest of the $40 level, although we already did kind of get one of those on Tuesday. You know, we broke above it. We came down here to the 40.17 or so. So almost a retest there of that level, and we've proceeded higher thus far. But on Friday, there's going to be an event, which we'll get to here in just a moment, which I believe could ignite the run at $50 that we've been looking at for a long time. But let's take a look at the rest of the sectors. So you've got gold has decisively broken out from this sideways consolidation that we've been watching since April play out here in the price of gold. We've got record all-time highs in the gold spot price. Seems like every day it's just taking out new record all-time highs. Same story. This is a 4-hour chart on the RSI. It is over 80 in gold. So maybe we need a little bit of sideways movement here for a few sessions just to kind of consolidate these gains. But any dips, in my mind, should be viewed as buying opportunities. That's just my opinion. It's not financial advice. But clearly, we are in the midst of a significant bull run in the metals. Here are gold futures. Now, this chart is notable because not only have we broken out of this ascending triangle consolidation that the gold futures chart was in, a very bullish chart formation to break out of, we are now above $3,600 in gold. And gold futures and the gold spot price, I think we're headed to $4,000 likely by year end. Now let's take a look at some of the miners. So we've got the SILJ Junior Silver Miner ETF here, broke out of a cup and handle formation, retested that, then it broke above this white line. To get the significance of that, we got to zoom out a bit more on a weekly chart, but you can see that since the creation of this SILJ ETF, it has been trading within this giant flag pattern, and we have broken out above that. So we are going much higher in the junior silver miners. I believe this is going to be one of the most active sectors of the precious metals market. That is my forecast. I own a lot of junior miners, and they've done pretty well thus far, but I think they are about to begin to move even more. Now, this is the GDX. This is a critical chart. This is a ETF that tracks senior gold miners. Now, look at this green line. This goes back to this level of about $64 or so, which was the top of the 2011 gold bull market. The gold price then around $2,000. The GDX topped out here, touched it several times to around that $64 line. Now look what we did. We've broken clearly above that level. So these miners, they've taken out the all-time high in this ETF. That means there's not going to be much resistance above this level, and I suspect this is going to be going much higher. So from a technical standpoint, all of these precious metals and precious metals derivatives are looking incredibly bullish here. This is the weekly chart of the GDXJ. This is an ETF that tracks the junior gold miners. Now I want to draw your attention to this upward channel that this ETF has been trading within dating back to late 2023. We just broke out above that as well. So all of these ETFs from a technical standpoint continue to put in breakouts, bullish developments, and while there may be some consolidation here, I suspect if it does happen, it's going to be brief, and then we are going to be headed much higher. Now, to see why the metals may get a real fire lit under them, and silver especially on Friday, we kind of need to examine how we got here. So some of the very bullish developments which propelled gold and silver to their current breakouts that played out over the course of the past month. One of the big ones was the U.S. jobs report for July, which was released on August 1st. So in that jobs report, it was very negative, much worse than expected. We saw May and June payrolls revised down by more than 250,000 jobs. So this is a very ominous sign for the U.S. economy, but the reason this is good for the metals is because this gives markets hope and conviction that the Federal Reserve is going to be easing sooner rather than later. And specifically, markets right now are looking for a September rate cut. We're going to talk about that in just a moment as well. Another story which helped to propel the metals to their current breakout was the Jackson Hole speech that Fed Chair Jerome Powell delivered, which was interpreted as very dovish. And Powell basically said that the Fed may be ready to adjust policy, and he downplayed inflation risks from tariffs, which had been a major reason why the Fed hadn't cut rates thus far. He's basically, in my interpretation of this, knuckling under to President Trump, who wants rate cuts. The president and the administration have kind of been waging their own campaign against the Fed. They targeted Fed Governor Lisa Cook, accusing her of mortgage fraud, trying to get her out of there to replace her with a more dovish replacement. So a lot of this movement that we have seen in the short term in the metals has been related to the Fed and the anticipation of monetary policy. Now this Friday, here's the Market Watch economic calendar. You can see that we have got another one of these employment reports coming up to be released at 8:30 a.m. Friday, September 5th. That's this Friday. If we get another very weak jobs report, if we see further downward revisions, and this is entirely possible. I mean, I suspect that if these government numbers are in any way grounded in reality, it will be a negative report because the U.S. economy is not doing very well right now. So if we get a very negative report, say it's worse than anticipated again, we get more downward revisions, that is going to really affect what the markets anticipate the Federal Reserve is going to do at the September 17th FOMC meeting. Now, right now, there is already being priced in a 95.4% chance of a 25 basis point rate cut at that meeting. This is part of why the metals are doing so well right now. So this is already priced in, though. I mean, we're seeing the metals go up and markets are anticipating a 25 basis point rate cut. This meeting could actually be a buy the rumor, sell the fact kind of an event, meaning leading up to this, we get the easy money priced into some of these assets like gold and silver. And then when the rate cut actually materializes, we might see a sell-off in those assets, right? That's the buy the rumor, sell the fact kind of dynamic, or buy the rumor, sell the news. However, I will say that while that is a potentially valid concern, one thing that could circumvent that is if the jobs report and any subsequent data that we get between now and this meeting, if it's very negative, we might actually get more than a 25 basis point rate cut. We could get 50 basis points, right? The president has already made it known that he thinks the federal funds rate should be a couple hundred basis points lower than current levels. So if the data is very negative and this potentially shifts to an anticipation of 50 basis point rate cut or more, or if what would be even more bullish for the precious metals would be if that doesn't happen and markets are still anticipating a 25 basis point rate cut, but then the Fed comes through with a surprise big rate cut, 50 basis points or more, that could very well be the factor that propels silver to $50 plus. And I don't think the bull run's going to be over then. Yeah, that would be nominal all-time highs. If you want to look at the previous bull markets in gold and silver, you can go back to 2011. If you inflation adjust that $50 price level, that would give you at least a mid $60 price target for silver. And if you go all the way back to the 1980 high of $50, you adjust that high for inflation, that would mean a record all-time high of silver around $200. And given the current state of the economy, we'll go over some of the numbers here in just a moment, I would not be surprised if we actually see silver ultimately head to those levels. Not saying that's going to happen this month, but in the long run, I remain incredibly bullish on the silver price. Now, let's take a look at the gold chart here, going back a little further. So yeah, we have the recent action, the breakout, but you can see that the current bull run in gold goes back to the bottom was in 2022, here around September and October. I mean, look, the gold price was in the 1600s then. Think about that. Just a couple of years ago, well, 3 years ago, you could buy gold for less than half of the current spot price. So if you bought gold back in 2022, you're doing pretty well for yourself. It's the same story with silver. I mean, silver, if you go back to the 2022 lows, you're talking about silver around 17, 18 bucks. Silver has more than doubled over the course of those 3 years. But what has been driving this move, particularly in gold? Because remember, gold is a very liquid market, right? It takes a lot of buying to move the needle on gold. It's a little bit different in silver. Silver is a smaller, much lower liquidity market. But what's driving the gold price from October 2022, in part at least, has been central bank purchases, right? You can see beginning in 2022, this is the central bank gold net purchases by quarter. You can see that in 2022, that number really picked up, right? This is Q3 2022, the highest quarter here. And since that time, central bank buying has remained elevated. In fact, if you look at this data, which goes back a little over a decade, you can see that the lowest months or quarters of purchases are equal to about the highest pre-2022. Now, what was the catalyst for that? A lot of it had to do with the war in Ukraine and the way that Russian assets were seized and sanctioned. It gave foreign central banks a dim view of the dollar or a diminished view of the dollar as a safe haven asset. So they started to load up on gold. And that has really been a main driver of this significant movement that we have seen in gold since that time period. Central banks now are beginning to buy silver. We covered this story in a recent video. You can check it out. I'll put a card up on the screen here if you want to get the details on this. But the Saudi central bank has invested about $40 million in silver. That's a small number, but we're going to see that number increase. And keep in mind, although that's not a huge number, $40 million for something like the Saudi central bank, it's not going to take that much purchasing of silver to drive significant movement. Keep in mind that an entire year's worth of silver production, it's about 1 billion ounces. At today's prices, that's about $41 billion. Even $41 billion for the entirety of central banks around the world, it's not that much. So there comes a point where when institutions like central banks become interested in a much smaller market like silver, it's not big like gold, small moves can have significant impacts on prices. And in that video I did covering the Saudi central bank purchases, I had someone leave me a comment that said, is there enough silver for all of the central banks? And the answer to that is that there's always enough silver. It just depends on the price, right? The price has to go up if you want all of these central banks to have a certain dollar allocation to silver, because it means more dollars chasing a finite amount of silver. So there's always enough silver, there's always enough gold for that matter. It just depends on what price you set. Now, this followed on the announcement last October of Russia's central bank to acquire silver for the first time. And so this is not a one-off event. The Saudis buying silver, right? This is part of a trend. Saudi Arabia is sort of part of the BRICS nations, sort of not. They're being kind of on the fence about that, but the BRICS nations especially likely very concerned about the role of the dollar as a reserve asset for their central banks. They don't want the liability. They don't want to be able to get locked out of Western financial markets. It's a huge threat for them. So they're going to want hard assets like gold and also like silver. Silver not only a reserve asset like gold, but think of the industrial uses for silver, right? It's a critical strategic asset as well. Your military needs silver. To have semiconductors and electronics and AI, you need silver. So there's more reasons than just the lack of counterparty risk that comes from owning a physical asset for these central banks and sovereign investors to want to get their hands on silver. And those trends, I believe, are going to continue to accelerate. Here's an image that Western investors, I think, certainly should be paying attention to. This is from August 31st. This is Narendra Modi, the Indian Prime Minister. These are some photos of him hanging out with Vladimir Putin and Xi Jinping at the SCO Summit. That's the Shanghai Cooperation Organization. And I just have a question for you. You can leave me a comment down below to let me know what you think. Do you think that these guys here want dollars, or do they want gold and silver? Do they want hard assets, or do they want fiat paper? I mean, I think that this is pretty much a no-brainer. What kind of assets these fellas are going to be interested in. And keep in mind that the countries that the three of these guys are running represent something like 40% of the global population. So we should definitely pay attention to this. This anti-Western hegemon of sorts, the BRICS nations, whatever you want to call them, they have a vested interest in promoting these alternative reserve assets to reduce their dependence and the world's dependence on the dollar as the world reserve currency. This is an illustration of why, even absent geopolitical tensions, etc., foreign central banks might want to have non-dollar assets on hand. This is the interest on the national debt. And you can see for decades, it was following sort of a normal progression upward, going up, but not at an alarming pace. But in 2020, that all changed. The interest cost was around $500 billion, and it rapidly ascended to where it's at today of about $1.13 trillion. So the trajectory of the interest cost on the U.S. national debt has really begun to accelerate to the upside. And this is a big reason why Trump wants a lower federal funds rate. And, if that doesn't work, which I don't think it will, to reduce the interest cost on the debt, it's not going to get bond yields down sufficiently to impact this. What the Fed is going to have to do is they're going to have to buy debt directly to bring the interest cost down. The Fed can buy an unlimited amount of U.S. debt, and they can do it at 0% interest. So that is a functional way to bring your interest cost down on your national debt. The problem with that is that it's quantitative easing, debt monetization. It's the sort of thing that banana republic governments engage in because it massively devalues your currency. This is the sort of thing you expect to see in Venezuela, in Zimbabwe, not in the United States and with the world reserve currency, but that's where we're headed. And it's because we have this ballooning, gargantuan U.S. national debt, $37.3 trillion, and the debts and deficits are only going to continue to grow. The big, beautiful bill, I don't know what's so beautiful about it, that was recently passed all but ensures that. That bill itself forecast to increase the deficit over the next 10 years by more than $3 trillion by the Congressional Budget Office. And that's not to have a $3 trillion deficit. It's going to take what we were already going to have, which was enormous, and tack another $3 trillion onto that. So this debt is going to massively expand, and we're going to see that interest cost continue to move higher until the Fed intervenes. And I think that that is what markets are beginning to get wind of here. That's why we're seeing the precious metals breaking out the way they are. And I'll leave you with this chart, which is of the gold to silver ratio. And this is something you absolutely want to keep your eye on, because this is probably going to be your number one indicator to tell you where we are at in this major bull market in the precious metals. Right now, the gold to silver ratio at 86.44. Now, you'll notice here on this chart that in 2011, at the peak of the bull market, the ratio dropped down as low as 32. So that is what you would expect to see at the end of a bull market, because typically you'll see the price of silver at the end of a bull market, at the blow off top, move faster than gold. But we haven't gotten anywhere close to that level yet. In fact, we're still at the very high end of this ratio. And this is a strong indication that even though we've seen impressive price action in the precious metals thus far, that it's nowhere close to an end. It is still just getting started. And in silver, when we do break through $50 an ounce, that's not going to be the end. That's going to be the beginning. But this is something that all stackers should be aware of. Even though we're at 41 bucks, I still think this is a decent entry point. In fact, I mean, now that we've broken above $40, it's kind of like buy now, not even down here, because now you know that the breakout is confirmed. Leave me a comment down below to let me know what you think about the topics that we covered today. Do you think silver is going to run at $50 an ounce before the end of September? I'm not saying it's guaranteed, but I do think there is a very strong probability of that. So thanks for watching, everybody. Stay safe and happy stacking. Don't forget to like, comment, and subscribe, and I will catch you next time. Smart Silver Stacker, out.